Hey, welcome back. Today I'm going to talk to you about building a tax free retirement account using a hybrid account or becoming your own tax free bank account. Now, with all of the stuff that's going on in the world today, with the national debt, banks going out of business, the market going up and down, and all the craziness that happens out there, wouldn't it be nice to know that you have a position that you could fall back on at any time and be able to access your cash without penalties and be able to do things that you wouldn't be able to do in a normal situation? Well, what if I told you you could grow your money tax free, access up to 85% of it at any time tax free, put it back if you want, get most of the gains of the market, never participate in losses, and when you die to pass on a 2 to 3 times that amount tax free? Wouldn't you want to do that? After all, millions of Americans just like you are doing that. And the wealthy are doing this to a very high level. So why not you? Well, that's called a maximum funded life insurance policy. And if it's done correctly under TEFRA, DEFRA, and TAMRA, in other words, you buy the minimum amount of insurance using the maximum amount of money, which those rules are set by the IRS, you're able to do all of those things. You're able to grow your money tax free, access up to 85% of it at any time tax free, put it back if you want, get most of the gains of the market, never participate in losses, and when you die, it passes on to 2 to 3 times that amount tax free. Now, the reality of the matter is that there really are three ways to take money out of a life insurance policy. But the first thing you got to do is you got to build it. And so once it gets built, then you're going to have access to that money. So let me just show you how that would work. If we go over here, there really only are two reasons to ever access the money out of that. Now, you could access it for any reason you want. They're not going to put any limitations on you. They're not even going to ask you questions as to what you're going to use the money for. And you can access it just like that. As quick as you could possibly want to access it, it can be from over here in the insurance company right over in your bank account at any given time. But the two main reasons to do this is for major capital purchases, anything that you cannot pay for in full with monthly cash flow, and investment opportunities, a potential to make more money or more return on that money than what's offered through your policy. Now, the cool thing about that is when we go out here, we go out and we build up this policy. As I said, you've got to build that policy up. Now, for the average person, this is going to take somewhere between 3 to 5 years or even longer to build a policy. But the fastest it can be done is if you're young, you could do it in about 3 years and one day. And if you're a little bit older, like myself, it'll take you 6 years and one day to do it. Now, the sad way is you die. And if you die, the money passes on tax-free to your heirs. The dumb way is a word called withdrawal. You would actually withdraw money out of your cash value. Now, when you withdraw money out of your cash value, there's limitations on how fast you can put it back, and you can only withdraw to the basis or the amount of money that you put in the policy. Any money you withdraw above that number right there, you're going to pay ordinary income taxes. So the smart way to do it is to always borrow. Now, we're not going to borrow our money. We're going to use our money to borrow money from the insurance company. We call it the collateral capacity. So the cash value that's inside of our policy, we have the collateral capacity to borrow up to 85% of that money at any given time. So our money is going to stay in that account. It's going to continue to make those gains of the market up to a limit, but it's never going to participate in losses, while simultaneously we're going to use that money on the outside. So we're leveraging our money by using the collateralization of that loan. Now, if we choose to pay it back, and I said if we choose to pay it back, we don't put the money into the policy, we pay it back to the insurance company. One of the coolest things about this is it doesn't show up on our tax return. It has no effect on our Social Security or Medicare or any other of our taxable income because it merely isn't a taxable event. The internal growth and additional contribution increase the collateral capacity over time. And anytime I need money, I can go get it. So if I need to buy a car, I'm going to need a down payment or even cash for a house, depending upon the size of my policy, I can go out and do this anytime I want. Now, the other reason to do this would be to go out and a policy loan for investments. So once again, I build the policy up. I have absolutely no restrictions. They're not going to ask me what I need the money for. They're simply going to give it to me because I have the collateral capacity inside my policy to borrow money anytime I want against the policy. So let's say I found an investment that I could go out and I could turn that investment into something that was making a pretty considerable rate of return. One of the interesting things about having money and having access to money is opportunities frequently are provided to you. So I go out and now what I do is I take that money and I invest it over in what I would call my risk tank. I invest it in, I don't know, stock market, whatever the case may be, and I have it working for me over there. Now, if I choose to pay it back, I'm going to pay back that loan. Maybe I pay it back with the gains off of what I made on my tank over here. And then I continue to grow my money and continue to grow my money while all the time that money that I had over on the side is going to continue to grow going forward. Now, folks, the reality of the matter here is that one of the best tools that you could ever do for building a retirement account is using some form of life insurance, whether that's a maximum fund life insurance policy, death insurance on your parents, premium finance. There's so many things that you can do with life insurance out there that you just can't even imagine. I'd love to hear your comments on what you think about this concept and how this would work for you. And if you want to know more, reach out to us at any time. Be sure to subscribe to our channel and remember to live like you're going to die tomorrow and plan like you're going to live forever because you just might. Keep smiling, and I look forward to seeing you very soon.